Hello UK investors, how are you doing? Brexit has been renewed for another season. Yes, so excited. And in the next season of Brexit, it's going to be about the election. Who will be the next Prime Minister? Which party will dominate? How does it affect the investors' world in the UK? Well, it's going to be volatile, and stick with me on this video. I'm going to show you how we can strategize and how we can profit from this Brexit from towards the end of 2019 to 2020. So stick with me on this video, and I'm going to explain to you the 3 key scenarios and how we can take advantage of it. So see you soon. Boom. Welcome back to my video on my Brexit investment strategy for 2020 onwards. And before I begin on my presentation, I would like to say that please like and subscribe on this YouTube channel, and so when I release videos in future, really informative video for free, you will all be the first to listen. Hope to share this and everyone to learn. So my name is Alex Ko. I'm the founder of www.mumuku.com. I personally am a UK investor. 7 years ago, I used to be broke. First child was born, I couldn't afford a baby pram. I was in debt by minus £10,000. And today, 7 years later, I've got a 6-figure portfolio. So, like I said just now, I need to give credit to Morningstar. I'll leave the link below. It's actually on my screen here. It's called Brexit Investment Strategies for Uncertain Times. This was released back in 29th of October, and I found this article really good. So what is this Morningstar article? It's really a good insight on what we can do to move forward if you are a UK ISA investor or a UK investor yourself. So it's 3 probable scenarios. The first one I'm going to go and explain is soft Brexit or no Brexit. Okay, so soft Brexit or no Brexit, in the article explains that, what should we do? Where should we go? I've lost my sheet. Oh, it's this one. I've written it down. So no Brexit or soft Brexit. What we should do is you should focus on UK companies, UK alone companies. For example, like banking, it'd be Lloyd's, not HSBC, because HSBC has got exposure to China. And you've got the housing market. You've got Persimmon, you've got Berkeley, you've got all the companies that's associated with housing. Retail as well, like Next, for example, like Primark, and companies like Marks and Spencer. So those are retail companies, are micro caps, smaller companies in a FTSE 250. And then, but why? Why do they think that you should, if it's a no Brexit, if you predict that it's a no Brexit on soft Brexit, why you should focus on these assets? Simple reasons, because since the Brexit began on the 22nd, 23rd of June back in 2016, all this market, all these companies has been hammered really badly. They have been declining. They have been on the brink of extreme decline because of the weaker pounds, and then people are not spending money. That's why if it goes reverse, if Brexit just goes away or a softer Brexit, we get a deal with EU, then these companies will actually soar because they're all bottom out. So what else? What should we not do? What should we not do if it's no Brexit? Is do not invest in FTSE 100 shares, all this large capital. Like, for example, it'd be HSBC, it'd be Shell, the likes of Diego, the likes of AstraZeneca has gone 75%, Unilever has gone almost 50%. Pounds, the UK pounds have dropped. And because these companies are global, they earn foreign currencies, so they're bringing the US dollars into the country, and then the profit has basically increased. So that's why, if the reverse goes, all these companies has been overvalued now will decline. That is what it means. So do you think that we will get a no Brexit or soft Brexit? I'll let you decide. Okay, so let's go on to the second scenario, which is hard Brexit. It means the EU is not going to give us any leverage. It's going to be hard Brexit. We're going to leave. We're going to pay the penalty. Or a no-deal Brexit. it's even worse. No deal Brexit. That's not what everyone thinks. It's wide opposition government is pushing to avoid that happening. It'd be the dollar earning large cap company. Like I said, it'd be like the Diageos, the Unilevers, the Royal Dutch Shell, HSBC. All the companies has got international exposure. Okay, and then defensive company, global funds like Lansdale Train Global Equity Funds, which I always recommend on my show. Those will be doing well. And then following on, what should you avoid? Okay, consumer focus. If you do go Brexit, hard Brexit, no deal, the likes of Next. I was going to say Mothercare, but Mothercare has already gone into administration. Marks and Spencer, Lloyd's Banking, even Cyrus Mineral, which is not even in development yet, but it's really popular. They all go down really dramatically. All the FTSE 250 will go down. All the house builders, Persimmon, Berkeley, they all go down. Retail that I mentioned earlier on. So what do you think? Do you think it will be a hard Brexit or a no-deal Brexit? Again, I'll let you decide. Okay? And finally, the third probable scenario will be a Corbyn government. Because currently we've got the Tories or the Conservative parties. We've got Boris Johnson running as Prime Minister, but in December, in the next 6 weeks or so, if he doesn't do well, if he loses out, and the Labour Party gets the majority vote, Corbyn comes in, what is going to happen? There is still a probability. So if that happens, the dollar earning global funds should be doing well. It's almost similar to a no deal, a hard Brexit. They should be doing well. But the one that we should be focused on, the one that you should consider if you own this sectors, which is a no-no, which will be hammered, is utilities, National Grid, water utilities. All these companies will be doing really badly because they'll be nationalized. Jeremy Corbyn has voiced his concern about nationalizing his company, nationalizing the post office again, Royal Mail, nationalizing. And the next one will be banks and finance. Jeremy Corbyn has already announced that all this banking, all his bonuses, all his high-paid CEO shall not be paid. He put rules in place to strangle this sector. So if you do own this, if it's most likely by the December comes in, if you think that Corbyn is getting momentum to win, maybe consider selling off. I personally would be. Okay, so I'll let you decide and have a think about your portfolio. So it's quite important. What are my thoughts? What are my personal thoughts? Because this topic is about my Brexit investment strategy. So my personal thoughts is, I don't think we will get a soft Brexit or no Brexit. So that I'm just going to wrap it off. I don't think we're going to get no Brexit. We'll still hammer on. Okay, Brexit will, unless Lib Dem comes to party, then things will change. But I think we will still get a Brexit. Brexit, no deal or hard, because I think we're running out of time, and both Labour and Conservative Party wants to get it done, but on different terms, obviously. So, or a Corbyn government, which is still likely because that man is popular, by the way. He is popular in all the major areas in the UK, so he might still win. So if you mix the two scenarios, we can actually get a common ground. That's what I see. So if you mix the two scenarios, what we should be taking advantage of is the dollar earning large cap companies and global funds. We should be avoiding utilities or consumer focused house builders, retail, or any UK buyers companies. So if you've got any of those, either shave it off or remove it. But I personally, I've already prepared since January. I do not hold any utilities. I do not hold any house buildings. I do not hold any local companies like Next, Primark. I do not hold Lloyd's. I do not hold any of those companies. I hold more international dollar earning companies like HSBC, Unilever. I hold Diageo. I hold global funds, Lansdale Train, global equity funds. So those are the ones I hold. So what I will be doing in the next couple of weeks, I'm going to monitor it. And because the pound is actually strengthening, it's 1.4 to the dollar. It's strengthening. So I'm going to try to slowly save a bit more and start buying high dividend ones. High dividend ones like Unilever. And the last 2 weeks, I've been buying a lot of Unilever because Unilever has dropped about 10%. So I've been buying lots of Unilever, really strong company. I've been considering more Diageo. I've been buying more Shell and BP for my kids. And so I've been going very defensive, high dividend, because these companies are paying between 4 to 6%. Unilever is about 3.5 to 4%. They're very high dividends and they're quite good value just now. Good P ratio. So that's what I'm doing, that's what I'm focusing on. And then if I got overall extra, I go global equity Lindsay Train funds, which is still my current favorite since the beginning of the year. So that's what I'm personally doing. So that's what I'm sharing with you. And so far my portfolio is doing very, very well. Which, who is this strategy for? Who is this strategy for? So, I've told you what I'm going to do, but obviously you're not going to go and buy every single share. So what you should do, if you got a lower capital of investment, you should just go get global funds. There are loads of global funds out there, like I mentioned, like 250 million times. I still like Lindsay Train's global equity fund. There are other global equity fund at lower cost, but I'll let you decide. Okay. If you got low, like I said, if you can only afford between 100 to 500 pounds a month that you can save, then just buy the fund. But if you're somebody who wants to try to buy dividend or buy a stock, make sure you got about 2,000 pounds or 1,500 to 2,000 pounds before you start buying any stocks, because you do not want to be hammered with the fees. Unless you go on free trade, you're a millennial, hip millennial. On free trade, those are free. Not free, but £1 to invest if you want instant access. Or if you don't wait till Friday, then you can go for the free one. But then for most UK investors, I believe they own AJ Bell, IG, Hargreaves Langston, Interactive Investors, then, at least £1,500 before you do invest. Okay? So, so you make a decision on the 3 scenarios which I've explained. Go read the article. Tell me what you think. Leave in your comments below if you agree or disagree, or maybe perhaps you've got a 4th scenario that I don't know. Okay, so I hope you find this useful, and please do your research before you execute anything, but feel free to ask me anything. I'll be more than happy to help. And you have a good day, safe journey, and remember to go and vote. This is just posted. Okay, have a good day. Bye.